Do you know if your business is the kind that private equity investors actually want to buy? Or if you're thinking of starting a business, how do you structure one that's the most appealing to private equity investors? Today, we're going to dive into the types of businesses that private equity investors really want to buy and invest in. First, let's talk about why you may or may not want to sell to a private equity investor. Now, selling to a private equity investor can be great. You get a big fat check and ride off in the sunset, potentially. There are lots of private equity shops out there chasing down deals. And so theoretically, you can get like a decent valuation on your business and find a buyer for it, even if it's not necessarily fit for strategics. Oftentimes, private equity funds are buying up multiple businesses and rolling them into a larger platform. And so, it's an opportunity to basically exit the business and be on your way and not have to worry about any future work within the business or having to find somebody else to keep running it and managing it, because the private equity fund will take care of that for you. It also means you don't have to be staying up all night stressing about your competition and how you're going to make payroll and, all of those other things. But some things that, you may not like. A private equity fund buying your business means that you'll get a lump sum of cash, sure, but you'll miss out on future revenues and profits from the business. You'll also be giving up like your baby, right? And once a private equity fund owns your company, they're the ones that decide what happens to your employees, what happens to the community where you built your business, what happens to the brand and what it stands for, a lot of those things. And, you may feel like you've done something really great in building this successful company that with a brand that stands for something, only to have a private equity fund come in, buy it, not really understand your business, and end up destroying it and destroying your brand and reputation to a certain extent in the meantime. So there's some definite risks involved with selling your business. But assuming that you're okay with taking those risks, or you're still interested in selling and moving on with your life, and buying that house on the beach and calling it good, let's talk about how you can really successfully attract a private equity investor by crafting and creating a business that's really attractive to them. So in order to do that, we really got to understand the three ways in which private equity investors make money. And that is primarily through leverage, through margin improvement, and through multiples expansion. Now, let's talk about the first one, leverage. So the way private equity works, and the reason it works, is because private equity investors don't just come in and write an equity check for your whole business. They use debt to buy it. So just like if you bought a rental property, you're not going to use all of your own cash to buy the property. You're going to borrow some from the bank. And then you'll use the rental income to pay down the debt that you borrowed from the bank. Private equity funds operate very similarly. They'll come in and they will buy your company. So let's say you are going to sell your business for $100 million. The private equity fund is going to borrow as much as they possibly can in most cases to buy that business. That could be 60 to 70% of the overall business. So they'll come in and they'll borrow $60 to $70 million, and then they'll put up $30 to $40 million of their own cash to buy the company. The beauty of using leverage is, let's say that you buy that business for 70% debt and 30% equity, and the business is generating, $20 million of profits annually. Well, that means that you can pay off the debt in as little as like 3.5 years. Well, that's pretty compelling, because if you did nothing else as a private equity fund, you just bought it for $100 million, financed it with $70 million in debt, used $20 million every year to pay down that debt, and then in roughly 4 years, you've paid off the entire debt, and then you go and sell it to another private equity investor or a strategic for another $100 million. So you're not even selling it for more than you bought it for. In that case, you'll have turned $30 million into $100 million in 4 years. That's a pretty good return. That's like 3x and a really good internal rate of return. So it can make a ton of sense for private equity investors to invest, because it can be super lucrative by using debt to finance those returns. So what that means is that as a company, you need to be able to support a lot of debt. And in order to do that, you need to have strong, steady, consistent cash flows. Cash flows that aren't dependent on just one customer. Cash flows that are pretty resilient throughout recessions. Ideally, cash flows that are tied to recurring revenue, where you've got contracts in place or you have very strong customer loyalty. And cash flows that are tied to big barriers that keep others from coming in and encroaching on your business. If you can do that and you can demonstrate to investors that you've got really strong cash flows, they will be like over the moon excited to invest in your business because they will know that they can borrow a lot of money from the banks and really drive up a huge return based on the leverage that they can get on the business. Now, the next way that they make money is through margin improvement. Now, with margin improvement, they'll look for ways that they can improve the business. So as a business, you want to be able to show them an area or multiple areas where they can add value and improve things. Now, there are a few ways in which, I see this happening fairly frequently with businesses that private equity investors come in to buy. One is what we call adjusted EBITDA, where they identify a bunch of things that they think that they can go in and modify and change. So for example, if you've got a lot of what are truly like personal expenses tied to the business, oftentimes private equity funds will come in and strip those out and be able to show like, hey, we're going to buy the business based on this EBITDA today or this cash flow, but just some minor changes, we think we can improve cash flow immediately. That will get them excited because they'll see like, hey, there's an opportunity here for me to pay down that debt even faster. Another thing that I've seen is, we saw this one private equity fund, they came in and bought Bell. They make the bicycle helmets and so forth. They saw an opportunity to move manufacturing overseas and really drive down costs. So for them, that was their whole trade. They just came in, they bought Bell, they moved manufacturing overseas, they ensured that everything was running properly, and then they sold it to another private equity fund. And at that point, they had better EBITDA margins, so they were able to sell it for more. So even though they only held it for a couple of years, it ended up being a really great investment for them, even in that short time period. And that might be the kind of thing where you look at the business and you say, hey, look, I know I've got to move things overseas or whatever it might be, or I know I need to move, my business to a cheaper location, or I know I need to upgrade this technology stack, or make certain investments in plants and property and equipment, but I'm just tired, I'm old, I don't want to handle that type of stuff, or I don't know how to do it, right? And I want to partner with someone who does. All of those could be great reasons to bring in a private equity fund, and where then they would be excited to do that deal because they see an opportunity to buy it at one price, make some obvious, easy operational changes, and sell it for a bigger price later on. That does mean, of course, that you're going to give up some of that return, right? Because you're not the one making those changes. But that can be an opportunity to do what we call taking a second bite of the apple, where maybe you sell the business to the private equity firm for $100 million. They borrow $60 million in debt. The private equity fund puts up $20 million. And then you roll $20 million of your ownership in the company, so that at the end of the day, the private equity fund cuts you a check for $100 million, and then you immediately give them back $20 million to own 20% of the business. And then the private equity fund goes to work to move operations overseas, and by doing so, maybe they grow the business now to be worth $150 million. And then you get to cash out $30 million. So you made $10 million by letting the private equity fund do the heavy lifting of actually making that transition happen. So, there are some ways that you can still capture some of that upside without having to do it yourself, while simultaneously demonstrating to the private equity investors that like, hey, there's a big opportunity here. If you're willing to roll up your sleeves and leverage your expertise, you could generate like a great return. The last one I want to talk about is called multiple expansion. So this is very similar to margin improvement, and oftentimes they're tied together. But basically, is there a way that they can increase the value of the business by improving revenue growth, or the quality of revenue, or customer diversification, or improve operations, or what have you? And so, oftentimes what I'll see is a private equity fund will come in and they'll be like, hey, here we've got this really great business. It's a really great platform. It's doing really well in like the Southeast, but we don't see any reason why this couldn't be a dominant player up and down the East Coast. And so they'll come in and they'll buy that one company, and then they'll look to bolt on additional companies. And as that company gets bigger and bigger and bigger and acquires more market share, then it becomes more valuable simply because it's bigger and less likely to fail. And they get what's called multiples expansion, where basically the business is worth more because either it's more stable, it's got better revenues, it's got better cash flows and profits, it's growing faster, whatever it might be, it just is inherently worth more for each dollar of revenue that the business or each dollar of profit that the business is generating. For example, if I take a business that only has one customer, those profits aren't super strong. But if I could buy it for cheap, and then I could bolt it on to this larger business where that one customer now becomes one of thousands of customers, then all of a sudden I've taken that profit and I've kind of diluted it and made it stronger across the board. And now the business overall is worth more because that revenue and those profits from that one business that I just acquired, when it's bolted onto a larger entity, I might buy it for like 3 times profits or EBITDA, and I bolt it onto a business that is now trading at 5 times EBITDA, I'm getting multiples expansion and making more money that way. So as you think about like what kinds of businesses fit within that framework where they have strong cash flows and opportunities for improvement, usually they fall into one of the following buckets. Sometimes it's services, it could be industrial services, it could be healthcare services, it could be consumer services. Sometimes it's software, particularly if it's a software business that's generating strong profits or has the ability to generate strong profits in the near term. A lot of the times it's B2B because B2B tends to be less fickle than B2C. And you have more recurring revenue that comes in on B2B businesses. Sometimes it's B2C products. So, in other podcasts I've talked about Hostess Brands, which I think is a great case study of private equity buying a B2C product. Although even Hostess Brands, even though it's a consumer brand, they mostly sell B2C because they're selling to grocery stores. But I've seen other private equity funds come in and buy e-commerce businesses and do very successful things for them. So broadly speaking, private equity loves businesses that are generating strong, steady cash flows. If you're building a high-growth startup and raising venture capital, probably not a fit for private equity, at least not in the near term. But if you're building a business that is strong and steady and, maybe it's not even growing super fast, but has really strong profits, then it can be a great fit for a private equity investor. What do you think about private equity investors? Is it the kind of business that you want to build and sell to a private equity fund? Let me know in the comments below. And check out some of my other videos like when will valuations get back to 2021 levels? Thanks.